In this episode, I will break down premium and discount arrays. This concept is simple and powerful, even when you don't have any specific directional bias. So, let's get into it. So the first thing to understand when marking out discount and premium is identifying the range. And for that, what I do is look for a swing high to a swing low, or essentially the most prominent range in that specific area of price action. Once I identify that range, I use either a fib tool or a range box, and I draw it from the swing high down to the swing low. Now once I do that, I can clearly see where the equilibrium of the range is, which is the 0.5 level on the Fibonacci. This level represents the midpoint of the range, so this is very important. Anything above the 0.5 level is considered premium. Anything below the 0.5 level is considered discount. To make things clearer, I often extend this range or box to the left so I can better visualize where price is trading relative to that equilibrium. Now, one important thing to understand is that there is not just one range in price. Price is always forming multiple ranges within ranges. For example, you might have a larger range from a major move down, but then inside that move, once price forms a new swing low and starts moving up, it creates a new internal range from that high to that low. So you end up with multiple ranges nested inside each other, and that can sometimes feel confusing at first. But once you practice, you start to understand which range is most relevant for your current setup. Now, before we move into examples, it's important to understand why we even use premium and discount. The main reason is because it helps us identify where risk to reward is more favorable. For example, if I enter a long position right at equilibrium, with my stop at the low and my target at the high, my risk to reward would be around 1-to-1. But if I wait for price to move deeper into discount, my entry becomes much better. My stop remains the same, but my target stays at the high, which means my risk to reward improves significantly. The same logic applies for short positions. If I enter a short at equilibrium, my risk to reward is average. But if I wait for price to move deeper into premium, I can get a much better entry with a higher reward relative to my risk. So with that being said, if I am looking for short positions, I want to look for PD arrays in premium. If I am looking for long positions, I want to look for PD arrays in discount. And that is the core idea behind using premium and discount in your trading. For this first example, we are going to take a look at NASDAQ on the daily chart. The first thing we want to do is identify a range, because everything starts from understanding the range. So if you look at the chart, we can clearly see that we have a swing low right here. And from that low, price starts to leg up. So what I want to do is mark out my range from that low up to the high that price is forming. Now, one important thing to understand is that ranges are not fixed. They are expanding. As price continues to move higher, I am going to track that movement with my equilibrium range. So as price pushes higher and higher, I will continue to adjust my range upward until a clear swing high is formed. So we let price play out. Now we can see that a swing high has been formed. So now we have a clear range from our swing low to our swing high, and we can properly define our premium and discount. Now the question becomes, if we are looking for long positions, what exactly are we looking for? We want to look for PD arrays in discount, because that is where risk to reward is most favorable for longs. So now we look at the chart and ask, do we have any discount PD array? Yes, we do. We have a fair value gap sitting right here in the discount area of the range. So if I am looking for longs, this is exactly where I want to focus. I want to be looking for long entries inside this fair value gap in discount. Now let's see how price reacts when it reaches that area. You can see that price retraces back down into that discount fair value gap, taps into it, and then from there price moves higher. So this example clearly shows how we use premium and discount together with PD arrays, and specifically how we look for long opportunities in discount, where price reacts and continues in the direction of the trend. For this next example, we are looking at GBPUSD on the daily chart. If you notice, price had already filled a daily fair value gap, And then from there, we made a new high with strong, aggressive displacement. That displacement gives us a very clear range to work with. So what I'm going to do is mark out that displacement range from the high to the low. And now I want to ask a very important question. If price is going to retrace into discount, do we have a PD array in discount that price can draw into? Yes, we do. We have a small fair value gap sitting in the discount area, and that becomes our point of interest. Now moving forward to the next day, you can see that price sweeps Monday and Friday's highs, then closes back inside the range. That tells me the market is likely shifting, and now I'm expecting price to draw lower into that discount fair value gap. So now if I'm looking for long positions, I don't just blindly buy. I want to see some sort of confirmation, like a raid on previous day's low. And that's exactly what we get. Price sweeps the previous day low, closes back inside the range, and now I look above and ask, what is price likely to draw towards? We have a fair value gap sitting above, so now I expect price to move higher into that target. At this point, I'll drop down to a lower time frame, in this case the 15-minute chart, to refine the entry. So here we are on the 15-minute. We mark out the new day, we have midnight, the Asia range high and low, and then we see price sweep the Asia low along with multiple lows, which also coincides with filling that fair value gap. After that, we get an aggressive move to the upside. Now this move creates a new internal range, meaning we now have a fresh premium and discount structure on the lower time frame. So what I do here is mark out that range and also apply an OTE, optimal trade entry. If I'm looking for a setup, I want price to pull back into that OTE zone, and from there, I'm targeting the daily fair value gap above. Now here's where the real advantage comes in. If I enter at equilibrium, my risk to reward is around 1.6 R. But if I wait patiently and enter at the OTE, my risk to reward improves to around 3.4 R. So not only am I trading with bias, I'm also improving my execution quality. Now as price plays out, you can see that price pulls back into the OTE zone. And importantly, there are no candle body closes below it, which tells me it is being respected. From there, price moves higher and eventually reaches into that daily fair value gap. And in fact, it even extends beyond that level, but the objective was already achieved. So this is exactly how I would frame a complete setup. Starting from the daily bias, identifying discount PD arrays, waiting for confirmation, refining on lower time frames, and executing with precision using OTE. I hope you found this video helpful and that it gave you a clearer understanding of how to use premium and discount along with PD arrays to build a solid trading narrative. As you can see, it's not just about marking a range, it's about understanding where price is within that range, where the high probability areas are, and then combining that with proper execution on the lower time frames to get the best possible entries with strong risk to reward. If you start applying this consistently, you'll notice that you're no longer chasing price. You're waiting for price to come to you into those discount or premium zones where the odds are actually in your favor. And remember, just because you have a bias doesn't mean you will get an entry every single day. The goal is to be selective, patient, and precise. If you enjoyed the video, make sure to like and subscribe, and I'll see you in the next one.